Last Tuesday, a colleague from Bridgewater called me. His 28-year-old son just took out a $200,000 loan against his startup equity to buy 2 Bitcoin. The kid told his father, "Dad, you don't get it. This is the future of money. I'll be retired by 35. My colleague asked what I thought. I told him the same thing I'm going to tell you right now. His son isn't investing. He's gambling. And he's doing it at the absolute worst possible moment in the cycle. Bitcoin just crossed $100,000. Everywhere I look, I see the same pattern. Uber drivers asking if they should buy, dentists checking prices between patients, retirees putting their life savings into crypto because their grandson made money on it. This isn't excitement. This is mania, and I've studied manias for 5 decades. They all end the same way, badly. Let me be crystal clear about something. I'm not some technology skeptic yelling at clouds. I built the world's largest hedge fund by understanding how the economic machine works. I've studied empires rising and falling, currencies collapsing, markets swinging from greed to panic and back again. And everything I see right now, every indicator, every pattern, every psychological signal is flashing red. This isn't about whether blockchain is interesting. It is. This isn't about whether decentralization has merit. It does. This is about whether Bitcoin at $100,000 is a good store of value or the final stage of a debt-fueled, speculative bubble before a devastating crash. And if you can't tell the difference between those two things, you're about to learn a very expensive lesson. Here's what I'm going to walk you through. First, where we are in the long-term debt cycle and why that matters for Bitcoin. Second, the psychological stages of bubbles and why we are in the most dangerous one. Third, historical parallels that should terrify anyone holding crypto. And finally, what's coming and how to protect yourself before it's too late. Because I promise you, it's later than you think.
Let me tell you about a meeting I had in 2008. It was September. Lehman Brothers had just collapsed. I'm sitting in a room with some of the smartest economic minds in the world, and we're all asking the same question. How did we not see this coming? The answer was simple. We did see it coming. We just didn't want to believe it. Because when you're in the middle of a debt cycle, when everything's going up, when everyone around you is making money, it's psychologically almost impossible to step back and say, this ends badly. That's exactly where we are with Bitcoin today. And to understand why, you need to understand debt cycles. Because Bitcoin's entire existence is a symptom of where we are in the biggest debt supercycle in human history. Here's how debt cycles work. In the early stages, debt is productive. You borrow to build factories, infrastructure, businesses. Those investments generate returns that exceed the cost of the debt. Everyone wins. Credit expands, economies boom, asset prices rise. But eventually, and this is critical, debt stops being productive. You're not borrowing to build anymore. You're borrowing to service existing debt, to maintain lifestyles, to speculate on assets. The debt keeps growing, but the productivity doesn't. And that's when central banks face a choice. Either let the system collapse or print money to keep it going. They always choose to print. After 2008, central banks dropped interest rates to 0 and printed trillions. That wasn't enough. COVID hit in 2020, and they printed trillions more. The M2 money supply in the United States increased by 40% in 2 years. 40%! That's not monetary policy, that's desperation. And here's what people miss about money printing. It doesn't create wealth. It creates the illusion of wealth by inflating asset prices. Your stocks go up. Your house is worth more. But you're not actually richer. The money supply just expanded faster than the real economy. When people realize this, and they eventually always do, they panic. They start looking for stores of value that governments can't print. Historically, that was gold. But gold is old world, heavy, slow, hard to move. So along comes Bitcoin. Digital, scarce, only 21 million will ever exist. Perfect narrative for an era of currency debasement.
And I'll admit, the narrative is seductive. No central bank can print more Bitcoin. It's mathematically enforced scarcity. If you're terrified about inflation, about government money printing, Bitcoin sounds like salvation. But here's what the Bitcoin evangelists don't understand. Yes, we're late in a debt supercycle. Yes, central banks have printed unprecedented amounts of money. But that doesn't mean Bitcoin is the answer. It means we're approaching the deleveraging phase. And in deleveraging, cash is king, not speculative assets trading at all-time highs. Let me explain what happens in a deleveraging, because I watched this in 2008, in Japan in the 1990s, in the Great Depression. It's always the same pattern, like a wave building and building until it crashes on shore. First, asset prices that were inflated by cheap credit start falling. Stocks decline. Real estate weakens. Speculative garbage gets annihilated. Second, everyone scrambles for liquidity. They sell anything they can to raise cash because debts still need to be serviced, even as asset values collapse. Third, forced liquidations accelerate the decline. Margin calls, redemptions, panic selling. Fourth, central banks eventually step in with stimulus. But there's a lag, and during that lag, fortunes are destroyed. We saw this exact script in March 2020. COVID hit. Markets panicked. And you know what happened to Bitcoin? It crashed 50% in days. It didn't act like digital gold. It didn't act like a safe haven. It acted like a leveraged tech stock. Why? Because Bitcoin's value isn't based on intrinsic utility. It's based purely on sentiment and liquidity. When liquidity dries up, Bitcoin doesn't have earnings to fall back on. No cash flows, no dividends, just the hope that someone will pay more tomorrow than you paid today. This is what should terrify you about Bitcoin at $100,000. We're not early in a debt cycle where risk assets thrive. We're late, very late, and everything built on leverage and speculation is vulnerable. Bitcoin isn't outside the system. It's the most fragile part of it. The people buying today think they're escaping the machine. They're actually feeding it their life savings.
I need to tell you about something I witnessed in 1999. I'm at a dinner party in Connecticut. The host, a successful surgeon, pulls me aside. He's excited. He just bought $500,000 worth of internet stocks, Pets.com, Webvan, companies losing money on every sale. I asked him, "Do you understand what these companies do?" He said, "It doesn't matter. The internet changes everything. Profits are an old economy metric." 2 years later, he'd lost everything. His kids didn't go to private school. He postponed retirement by a decade. And you know what he told me? "I thought this time was different." That phrase, "this time is different," those are the 4 most expensive words in investing. And I'm hearing them everywhere about Bitcoin right now. Every bubble follows the same psychological arc. Let me walk you through the 5 stages so you understand exactly where we are. Stage 1, the smart money phase. This is when true believers get in, people who understand the technology. With Bitcoin, this was 2009 to 2013. Cypherpunks mining coins in basements. They weren't in it for money. They believed in decentralization. This stage is harmless. Prices are low. Volume is small. The general public doesn't care. Stage 2, the awareness phase. The innovation gains traction. Prices start rising. Media coverage increases.
Bitcoin from 2013 to 2017, it went from an obscure curiosity to something your coworker might mention. $100 to $20,000. Early adopters made life-changing money. This creates social proof. If your neighbor bought at $500 and it's now $10,000, your brain screams that you're missing out. Stage 3, the mania phase. This is where we are now. And this is the most dangerous stage. Everyone's talking about it. FOMO is overwhelming. Rational analysis disappears. Anyone questioning the narrative gets attacked as not understanding the paradigm shift. Let me tell you what mania looks like up close. I'm getting emails from people I haven't heard from in years asking about crypto. My barber told me he's buying Ethereum with his tips. A 19-year-old kid working at Bridgewater asked if he should drop out of college to trade NFTs full-time. This isn't investing. This is psychological contagion. And the dynamics in this phase are brutal. Early buyers made fortunes, so they evangelize. Not because they're dishonest, but because they genuinely believe and they've been rewarded. This creates powerful social pressure. You feel stupid for not buying earlier. Your brain tortures you with counterfactuals. If only I'd bought at $1,000, I'd have $100,000. Then there's narrative escalation. In stage 2, people said Bitcoin might hit $10,000. In stage 3, they say it's going to $1 million or $10 million. The targets keep moving because the psychology demands it. Nobody wants to hear Bitcoin is fairly valued. They want moon. They want Lambos. They want early retirement. You also see the dismissal of traditional analysis. In the dot-com bubble, people said, earnings don't matter. It's about eyeballs. In housing, they said price-to-rent ratios were outdated. With Bitcoin, people say cash flow doesn't apply to stores of value, or you just don't understand money. When people tell you the old rules don't apply, that's not insight. That's delusion. The old rules always apply. Assets need intrinsic value or cash flow to justify prices long term. When they don't, prices eventually collapse. Stage 4, the blow-off top. This is where things go truly insane. Prices go parabolic in a final surge. Media coverage saturates. Institutional investors who stayed away jump in, terrified of missing out. This might be where Bitcoin is heading next. $150,000, $200,000. I don't know. But the higher it goes, the harder the fall. Stage 5, the crash. Something changes. Maybe it's regulation. Maybe it's a hack. Maybe prices simply stop going up and momentum traders bail. Whatever the trigger, sentiment flips instantly. The psychological forces that drove prices up now drive them down, but faster, much faster. Leverage unwinds, stop losses trigger, panic sets in. We've seen Bitcoin do this twice already. 2017, under $1,000 to $20,000, then crash 84% to $3,200. 2021, $69,000, then down 77% to under $16,000. Both times, identical psychology: euphoria, blow-off, panic, collapse.
The only question is whether we're in late stage 3 or early stage 4. But either way, stage 5 is coming. It always does. The pendulum always swings back, and when it does, most people holding Bitcoin will lose everything. Let me tell you 3 stories, and I want you to think carefully about the parallels to Bitcoin. France, 1720. The Mississippi Bubble. John Law convinced the French government to back shares in the Mississippi Company. The story was simple. Vast riches awaited in France's Louisiana territories. Shares went from 500 livres to 10,000 livres in months. People mortgaged homes to buy in. The government backed it. Smart people owned it. It seemed unstoppable. Then someone asked a simple question. Where are the actual riches? Ships came back from Louisiana without gold, without trade goods, just stories. Confidence broke. Within a year, shares were worthless. The French economy collapsed. People who'd mortgaged everything lost their homes. Some committed suicide. The parallel? A revolutionary narrative backed by increasing institutional credibility, driving prices to levels disconnected from reality. America. 2000. The dot-com crash. The internet was going to change everything. And it did. But that didn't stop investors from bidding up companies with no path to profitability. Pets.com spent millions on a Super Bowl ad and went bankrupt 9 months later. Webvan raised $375 million and was liquidated within 2 years. eToys hit an $8 billion valuation and went bankrupt. The Nasdaq dropped 78% from peak to trough. But here's the part people forget. Even the survivors got destroyed. Amazon fell 95%. Cisco took 17 years just to break even if you bought at the top. You could have been right about the technology and still lost everything by paying too much. The parallel? Revolutionary technology becoming justification for ignoring fundamentals. America 2008. The housing crash. Housing prices never go down nationally. Everyone needs shelter. Land is limited. These were the narratives, and they were backed by sophisticated financial engineering, mortgage-backed securities, CDOs. The smartest people on Wall Street said the risk was minimal. Then housing prices fell 30% nationally. The global financial system nearly imploded. People lost homes, retirement savings evaporated, and the excuse was always the same. I didn't think it could happen. The parallel? Leverage and derivatives, applied to an asset everyone believed could only go up. Now look at Bitcoin. Revolutionary technology, sophisticated narratives about monetary policy, institutional involvement with BlackRock offering ETFs, Michael Saylor leveraging his entire company, crypto exchanges offering 100-to-1 margin, complex derivatives built on top. Every ingredient that created past disasters is present. The only difference is the names and the technology. The psychology is identical. And the psychology is what kills you. I'll tell you something else. In every bubble, early adopters make fortunes and late arrivals lose everything. If you bought Bitcoin at $100, congratulations, you're rich. But if you're buying at $100,000, you're the exit liquidity. You're the person left holding the bag when the music stops. And I promise you, the music always stops. Always. I've spent 50 years studying how the economic machine works. And right now, I'm watching that machine break down in real time. Let me tell you what I see coming. Scenario 1. The regulatory sledgehammer. Governments are waking up to the threat crypto poses to their monetary monopoly. China already banned it. The U.S. is tightening regulations. The EU is following. What happens when the U.S. government decides to seriously crack down? Bans on exchanges, prohibitions on banks facilitating crypto transactions, punitive taxation.
Bitcoin's value depends entirely on the ability to freely buy and sell. If governments remove that, it becomes worthless overnight. And don't think it can't happen. Governments have confiscated gold. They've banned currency exports. They've frozen bank accounts. When the state feels threatened, it doesn't play nice. Scenario 2. Technical obsolescence. Bitcoin's technology is from 2009. It processes 7 transactions per second. Visa does 65,000. It's slow, energy-intensive, clunky. What happens when something better comes along? Or when quantum computing cracks Bitcoin's encryption? Network effects aren't permanent. MySpace had network effects until Facebook showed up. BlackBerry dominated smartphones until iPhone arrived. Being first doesn't guarantee you'll be the winner, especially in technology where things move fast. Scenario 3. The deleveraging tsunami. This is what I think happens, and this is what should terrify you. We don't need a dramatic ban or technical failure. We just need the broader debt cycle to turn. When the next recession hits, when credit tightens, when forced liquidations begin, Bitcoin will get sold. Hard. People will sell to cover margin calls, to pay mortgages, to raise cash. And when everyone tries to exit at once, there's no floor. In March 2020, we got a preview. Bitcoin fell 50% in days. It recovered because central banks printed unlimited money. But what happens when they can't? When they've already printed trillions and inflation is the bigger threat? That's when Bitcoin's lack of intrinsic value becomes brutally, painfully obvious. There's no company generating earnings, no dividends cushioning the fall, no tangible assets backing it, just code and belief. And when belief breaks, there's nothing left. This is the part where I tell you what to do. And I need you to listen carefully because this might be the most important financial advice you ever hear.
First, never hold more of a speculative asset than you can afford to lose completely. If losing your Bitcoin position would hurt you financially, you're overexposed. Period. I don't care what your nephew says. I don't care what's trending on social media. If you can't stomach it going to zero, you have too much. Second, if you've made significant gains, take profits, rebalance, lock in real money. I know it's painful watching Bitcoin go up after you sell, but nobody, and I mean nobody, ever went broke taking profits. You might miss upside, but you'll also protect yourself from the downside, and the downside is coming. Third, diversify into productive assets. Companies that generate cash flow, real estate that produces rent, bonds that pay interest. These assets have value that doesn't depend on finding a greater fool. They produce income even if prices fall. Fourth, hold cash. Cash feels boring when Bitcoin is up 10% a week, but cash gives you optionality. When assets get cheaper, and they will, you'll have ammunition to deploy. The investors who win through cycles aren't the ones who make the most in bubbles. They're the ones who preserve capital and buy at the bottom. Finally, study history. Read about past manias. Understand the patterns. Human psychology doesn't change. The narratives change. The technologies change. But greed, fear, and the boom-bust cycle repeat endlessly. Bitcoin at $100,000 represents the late stage of a speculative mania driven by unprecedented monetary expansion, psychological contagion, and institutional participation that arrived after the smart money already cashed out. Every historical parallel is flashing red. Every psychological indicator says we're at or near the top. Every aspect of the debt supercycle says deleveraging is coming. Will Bitcoin go to zero? Maybe not. It might stabilize at some lower level. Will it hit $1 million? Anything's possible in a mania. But the risk-reward at $100,000 is terrible. You're risking most of your capital for diminishing upside, and the downside is catastrophic.
That colleague whose son borrowed $200,000 for Bitcoin, I told him to have a conversation with his kid, not about technology, not about the future of money, about risk, about cycles, about what happens when you leverage yourself to chase something you don't fully understand at the peak of a mania. Because here's what I know after 5 decades of watching markets: the machine always rebalances, the pendulum always swings back, and when it does, the people caught on the wrong side don't just lose money, they lose years, sometimes decades, sometimes everything. The wave is cresting. I can see it building. And when it crashes, the undertow will be brutal. You can choose to ride it down, telling yourself this time is different, or you can step back, preserve your capital, and wait for the inevitable reset. Because I promise you one thing: when the tide goes out, when the leverage unwinds, when the mania breaks, there will be 2 types of people: those who protected themselves and those who learned the most expensive lesson of their lives. I know which one I'd rather be, and I think you do too. The music isn't just slowing down, it's about to stop. And when it does, you don't want to be the last one standing when the lights come on.